Hey guys, Ryan with Greystone Mortgage. Today I want to talk to you about Fannie and Freddie's automated underwriting systems. Whenever we take a loan application, what we call a 1003, this information is put into an automated underwriter to pre-screen it through a bunch of different algorithms within Fannie and Freddie Mac. Then it gives us some sort of findings on what it's going into. Then the underwriter takes those findings and compare what's actually true to what we've actually put on the application. So for instance, let's say on the application we put they make $3,000 a month. We get the pay stubs together and it's averaging maybe $2,938.28. So the system adjusts for that as well. But basically every loan that gets done nowadays gets run through one of these automated underwriters to give us a preliminary idea if the general guidelines are being followed. Then we just have to prove the information we put in the system is accurate. And it gets rerun several times during the process when new information is found. Well, Fannie and Freddie are always updating this software. They're always changing the guidelines to fit the risk that's out there or the changes within the housing markets and things like that to always adjust for risk. So Fannie Mae just released their update. They're doing a couple big changes. They are allowing more leeway between a 45 and a 50% debt ratio, which I think is crucial. Because if we always say that 45% is the max that we will do, well, somebody that's a higher income earner, they still have a lot of money left over, even if they are at 45%. Vice versa, if you don't make as much income, maybe it should be less than 45%. So the software programs adjust for that as well, what's left over. Next, Fannie is releasing a new ARM product. This product is a 5-year fixed, then a 5-year reset. So instead of every year after that adjusting, it's every 5 years. So there's only one adjustment every 5 years. And it's tied to a pretty tame index, and it can only adjust 2% at a time. So it does have some more stability to it than the traditional 5-1 ARMs that we've been seeing out there. So this is a new ARM product that I think you'll see more people asking about, is what they're calling a 5-5 ARM. Fixed for the first 5 years, then adjust once every 5 years after that. So it's going to be a much more stable index. Also, they're offering differences for employment. So we're seeing a lot of times where people are under contract to go work for an employer, but it doesn't start for maybe 30 or 60 days. Maybe you're a doctor, a dentist. There's a lot of different professions out there that you get a contract to go to work, but you may not start work, or you may not have your pay stub for a couple months until you transition. They are now allowing us to use that base pay to qualify. We just have to show the letter. There's a couple things to jump through there, but that's huge. When you have somebody relocating to an area, they get an offer to work, but they don't have a pay stub for a while, we actually can use that income starting now. They're also changing timeshares. Timeshares on some mortgage reports say they're a mortgage, and others they say it's an installment. Fannie is now just saying let's call them all installment, which changes the way the underwriters have to view that debt. That's really a big change as well. It just really helps clarify some confusion within the marketplace. The last one I wanted to point out is student loans. These have always been an issue that's kind of been up and down when so many student loans are deferred. So we need to still figure out what payment there's gonna be in the future. Well, Fannie and Freddie kind of came up with the idea of 1% of the balance unless we can get a letter saying what the payment will be when it comes out of deferment. But we still had to hit them for some sort of payment. Now we can show if it really is a zero payment because of some program, we don't have to hit them for a payment at all. So the student loans are kind of going back to what we used to use and not necessarily always having hit everybody with a student loan payment. Another big thing with student loans, if you have equity in your home, you now can treat it as a refinance to cash out or pay off that student loan without the hit to the interest rate. So when you have a rate and term refi, the rates are better than when you're doing a cash out refi. They call them loan level adjustments. They're now releasing that if it's a student loan being paid off as part of the debts, we don't have to have that hit to the interest rate as a cash out. So they're removing that adjustment. That's big. So now you have the opportunity to get better rates if you're paying off student loans if you're doing a refinance. So if you have a lot of student loan debt and you're wanting to look at refinancing that or lowering the payment or consolidating it into one loan, you can now do that through your first mortgage. So I'd love to talk to you about the different loan programs that are out there. We're on top of this stuff. I see the news reports. I see the compliance stuff. This just got released. It goes into effect next week. We really want to help you with your home loan. Whether you're looking to purchase or refinance, give me a call at 435-627-0494 or visit my website at ryanbolton.com. Thanks for your time.